Well, after a really calm 2017, volatility came back substantially in 2018, starting from the very first week of January, where gilts started to weaken on the potential rising interest rates in the US and the effects that might have for the rest of the year. Further to that, trade tariffs were introduced by the US, which sparked fears that they may descend into a potential trade war with China. UK government bond markets fell through January, right through to mid-February, where they started to recover a little bit. By the end of March, they had reached the levels where they started the year pretty much, and treasuries weren't far behind as well. As far as the bond assets we've got in our portfolios, they didn't fall nearly as much as sovereign bond assets throughout the period, and therefore were a lot more robust. Our biases and portfolios for higher growth equity protected the portfolios better in January, but actually they were slightly worse on the downside in March. In emerging markets, we've got overweights in China and India. China has been really resilient over the first quarter, and India less so due to the implementation of new capital gains tax laws. The commercial property element of our portfolio has been really resilient during the recent market falls. We don't expect to see very high returns from UK commercial property this year, but what we have got is a really solid real return. Despite a greater range of stock market movement recently, fundamental economic data remains very strong in most regions, as do corporate earnings. We believe that with a positive business environment, we can still see really positive returns from equities this year.